And get started. Good morning, everyone. Thank you for joining us and welcome to today's webinar on the fundamentals of fixed income investing. I'm Audrey Melville, the Marketing Director here at Gabelli Funds and your moderator for today's session. And I'm thrilled to be here with our two distinguished experts from Gabelli, Ron Eaker and Wayne Plewniak, who will help us demystify the complex world of fixed income investments. For those of you who are not familiar, Gabelli Funds is an asset management firm founded by Mario Gabelli in 1976. And today we manage over $30 billion in client assets across a broad set of asset classes. Our dedicated teams of analysts and portfolio managers apply fundamental bottoms-up research utilizing our firm's private market value with the catalyst investment approach. So joining us today is Ron Eaker, a treasury specialist with extensive experience in government and corporate bonds and the co-portfolio manager of the Gabelli U.S. Treasury Money Market Fund. And Wayne Plewniak, Gabelli's head of fixed income and portfolio manager for a variety of our fixed income solutions. Together, they bring a combined 81 years of industry experience and a deep understanding of the market dynamics that drive fixed income strategies. So thank you both for joining me today.
Thank you. Thank you. Thank you for making us feel so
old. Great. So to kick it off, fixed income fundamentals. I'd love to just talk briefly about, in your own words, what fixed income is and summarize some of the key statistics of the fixed income market today.
Sure. Thanks, Audrey, and thank you, and good morning to everybody out there. I guess a simple description of fixed income would be it's a type of investment that promises a fixed rate of return, a fixed return over a specified period of time. This is typically in the form of periodic interest payments, followed by the return of principal at maturity or on some other specified date, such as in the case of calls or puts. Fixed income investment represents money lent to an entity, as opposed to, in contrast to equities or stocks, which represents ownership in the entity, entitling you to shares of the profits and voting rights, et cetera. As an asset class and within the capital structure, fixed income is characterized by its predictability and relatively lower risk compared to equities. Some common issuers of fixed income securities are governments, sovereign governments, government agencies, supranational organizations, municipalities, corporations, financial institutions, et cetera. The fixed income market globally is something over $130 trillion, which compares to global equity markets are probably 110 trillion or so. In the US, the fixed income market is over $50 trillion, about 40% of that global total. US market is roughly 2.5 times the size of China, 4.5 times the size of Japan, which are second and third in the world. The largest single issuer of debt in the world is the United States Treasury. Our cumulative debt of over $34 trillion, 27 trillion of which is securities held by the public, makes our treasury market the largest and most liquid in the world. The domestic corporate market is over $10 trillion, comprised of probably in the neighborhood of 9 trillion or more in investment grade corporate securities and a little over $1 trillion in high yield or junk bonds.
Great. Thank you, Ron, for that comprehensive overview. I think that really helps set the stage for understanding the crucial role of fixed income investments in today's economy. So building on that, I'd love to just delve a little bit deeper into some of the fundamental fixed income principles, including the different types of fixed income investment opportunities available to investors and how they differ.
Great. As Ron said, fixed income investments are the securitization of any entity's debt that provides a predictable stream of income over a specified period, culminating in the eventual return of that principal on a specified date. Unlike variable income securities, where payments may be based on some underlying measure or reference, such as short-term interest rates, the returns of fixed income securities are known. So some key takeaways. Fixed income securities provide investors with a stream of fixed periodic interest payments and the return of principal at maturity. Basic features of a bond include the issuer, maturity, the par value or principal amount, the coupon rate and the payment frequency, as well as the currency of denomination. Bonds are the most common type of fixed income security. And they're different bonds have different term lengths and features depending upon the issuer's wishes and the requirements and or tolerances of the market at the time of issuance. Rating agencies assign ratings to the bond based on the issuer's creditworthiness and financial situation. And fixed income securities from the U.S. Treasury, as Ron said, are backed by the full faith and credit of the United States government and making them a very low risk investment, but with relatively lower returns, perhaps, than some other forms of fixed income investment. And one of the important things to note here is the inverse relationship between price and yield. People often have trouble with that. And so just reminding folks that when the price of a bond goes up, the yield that you're receiving declines. And conversely, when the price goes down, the yield that you're getting goes up. So building a little bit more and elaborating on some things that Ron said, there are several types of fixed income investments available to investors, each with their own characteristics, risk return profiles, and tax implications. As Ron pointed out, they're sovereigns or government paper. And these are issued by national governments, and they finance everything from public spending to infrastructure projects to defense and the like. And usually they're backed by the full faith and credit of the issuing government and making them relatively lower risk investments. In the case of the United States, our debt's issued by the United States, U.S. Department of Treasury, and we have Treasury bills, notes, and bonds, as well as TIPS, which are inflation indexed securities. And it also includes U.S. government savings bonds. And then there are U.S. government agencies, or GSEs, which are government-sponsored entities. And these are, you might be familiar with, like Ginnie Mae, Fannie Mae, Federal Home Loan Bank, Freddie Mac, and these are entities that are supported by the government, and they are the credit. I should say their issues are backed by the creditworthiness of those GSEs, but because they're government related, there is typically perceived to be a strong implied or sometimes explicit guarantee from the U.S. government associated with these. So these trade right on top of treasuries typically. And then there's supranational bonds, as Ron mentioned. These would be things such as the IMF or World Bank, the OECD, European Union, things such as that. And then there are municipals. State and local governments issue bonds. There's typically two types of these: general obligation and revenue bonds. General obligation sort of is straightforward. It's a general obligation of that municipality, whereas a revenue bond is backed by a specific the revenues or the rents off of a specific project. Then there's corporate bonds. And as Ron mentioned, these range between investment grade all the way down to high yield, and then below that distressed. Then there's commercial paper, which is typically very short term, 270 days or less. And this is issued by a number of corporations with short term commercial paper programs in place. Then building on that, there are asset-backed securities. And these you might be familiar with: mortgages, auto loans, credit card receivables. And these are usually tranche structures, allowing investors to go and pick the tenor that they're interested in and or the credit quality of the tranche as well. In addition to that, there are certificates of deposit. There are time deposits from banks and convertible bonds and preferreds, and even preferred stocks, which are senior to common shares and that offer a fixed coupon in preference to the dividends paid to common shareholders. Anyways, these are just a few of the many different types of fixed income investments available to investors. and each offer, unique features and benefits. I think that's pretty complete.
Yeah, no, thank you for that comprehensive overview. It's clear that the diversity within the fixed income space certainly provides different options for many different types of investors. So considering all of the different types of fixed income investment opportunities, I think it's important to discuss how these investments differ in terms of risk and return. Could you talk about the risk and return of the profile of U.S. Treasury securities compared to that of corporate bonds?
Sure. As with most things, generally, the more risk one is willing to take, the higher the potential reward that one usually demands. So one of the most significant differences between U.S. Treasuries and corporate bonds is credit risk. Wayne touched on it. U.S. Treasuries are considered virtually risk-free, backed by the full faith and credit of the United States government. This means that the likelihood of the U.S. government defaulting on its debt obligations is extremely low. Although you're probably aware that there's been several times in recent years that the prospect of a default on the Treasury did not seem so far-fetched. Corporate bonds, on the other hand, are subject to credit risk. The issuer's ability to make a timely interest payment or repay the principal at maturity is contingent upon their creditworthiness and financial health. Corporations can't print dollars the way the U.S. Treasury can. If we look at a graph of yields as a function of maturity, in this case, all U.S. Treasury yields across all maturities and at a single point in time, that's what we call the Treasury yield curve. So corporate bonds and many other debt instruments generally carry higher credit risk than U.S. Treasuries, and they're typically priced using a spread relative to the Treasury base rate. Both Treasury securities and corporates are exposed to interest rate risk, which is, as Wayne pointed out, the mathematical fact that bond prices are going to fluctuate inversely with changes in interest rates, prevailing interest rates in the market. So bear in mind that the spread pricing relationship that I spoke about is not static. The underlying economic reasons for any shift in the interest rate or the yield curve generally can contribute to those relative spreads narrowing or widening at a given point in time. So that a shift in the Treasury yield curve does not necessarily correspond to a one-to-one shift in the corporate curve or the curve for any other asset class. In terms of return, as Wayne pointed out, as risk-free proxies, the U.S. Treasuries are typically lower yields compared to corporates and other asset classes with similar maturities. Investors are willing to accept lower returns in exchange for the safety and relative liquidity and stability of the Treasuries. In corporate bonds, investors, on the other hand, are going to demand compensation for the added risk in the form of higher returns. In the same manner, A-rated corporates are going to be yielding lower than B-rated corporates. Another significant difference, and one to keep in mind, is the tax treatment of income on various fixed income securities. The interest income from U.S. Treasuries is exempt from state and local taxes, subject to federal tax, whereas the corporate income on corporates is generally taxable at all levels. Income on munis, depending on what state you live in and what state you buy the muni from, could be exempt from all taxes at all levels.
Got it. No, that's a very helpful distinction, particularly the points on credit and interest rate risks, which are both critical factors for anyone thinking about different types of fixed income investments. Something that you touched on was yield, and which is a fundamental concept of fixed income investing. So could you just elaborate on what yield means and why it's important for fixed income investing?
Sure. Let's think about it as prevailing yield, if you will. There's the Treasury base rate that Ron spoke of with regard to the yield curve built the time series of yields for various length treasury bonds or securities, plus a spread, and that's credit spread. And so those two together are sort of the prevailing yield. The term yield refers to the return of an investment over a specific period of time. Typically expressed as a percentage of the investment's initial cost or current market value. And in the context of investments, yields represent income generated by the investment in terms of coupon, or if you will, the periodic rents that you're getting for the lending of your money. And there are several calculations that are commonly used. One, current yield. Current yield calculates the annual income generated by an investment relative to its current price. So in other words, that's calculated by dividing the annual income, think coupon payment or coupon, divided by the current market price of that security. That's current yield. And it provides an investor with a snapshot of what that investment's income generating potential is at a given point of time. That's pretty straightforward. Yield to maturity is probably definitely the more important one. And that yield to maturity represents the total return an investor can expect to receive by holding that bond to its maturity. And assuming that all coupon payments are made and that principals are returned at the end, along with, and it takes into account not only the bond's coupon payments, but any amortization of a premium that was paid for the bond or a discount to par that was available at the time of purchase. And that's yield to maturity. Yield to call is kind of similar to yield to maturity, but it applies to callable bonds, which give the issuer the option to redeem the bond at a given point in time. And yield to call just simply calculates the total return to that specific call date and call price. And then there's what we call yield to worst. Yield to worst also applies to callable bonds. And perhaps there's a series of different call prices and potential call dates. And what this is the calculation of the worst, if you will, the worst case scenario. If you buy the bond today at thus and such price, this is the worst that you should expect or would expect to yield if the company took those bonds away from you at what would be the most advantageous time to them, probably the least advantageous time to you. Anyways, that's what that is. So it yields a critical measure of an investment's income generating potential. And it's an important for fixed income investors for several reasons. One is the comparison of investment options, obviously. By comparing yields, investors can identify investments that offer attractive returns relative to their risk profiles and within an investment strategy. It also allows you to assess risk and return. Generally, higher yields, as Ron pointed out, are associated with potentially riskier investments. And conversely, lower yields are associated with less risky investments. Yet, by considering these alongside and comparing the relative value of different potential investments, you can see, perhaps within an industry, within a company's capital structure, the ones that are most attractive or may meet your specific investment goals and objectives best.
Got it. Understood. Thank you for clarifying the concept of yield, especially talking about the different types of yields that investors need to consider. And I think understanding yield really helps investors appreciate the role of fixed income in a diversified portfolio. So can you elaborate on how these investments contribute to diversification and risk management?
Sure. Without going into a full-blown discussion of asset allocation, I'd say that fixed income investments can play a very crucial role in a diversified portfolio. Fixed income investments, particularly high quality bonds such as U.S. Treasuries and investment grade corporates, are known for their relatively lower risk compared to the equity market, to equity securities and other asset classes. They can provide a buffer against the volatility of the stock market, helping mitigate overall portfolio risk. during periods of market downturns or economic uncertainty. The relative stability of fixed income assets can help cushion losses and preserve capital. One of the primary purposes of fixed income investments is to generate regular income in the form of interest payments. Bonds typically offer fixed or at least predictable income streams. This income component can be especially valuable for retirees or others looking to supplement their investment returns with predictable cash flow. Fixed income investments, especially those with shorter maturities and high credit quality, are often used to preserve capital. While equities carry the potential for higher returns, they also come with greater volatility and an increased risk of capital loss. By allocating a portion of the portfolio to fixed income, investors can safeguard a portion of their wealth and maintain a more stable investment base. So including fixed income investments in a diversified portfolio helps spread risk across different asset classes. This diversification strategy can enhance risk-adjusted returns by reducing the overall volatility of the portfolio. When stocks experience declines, the stability in the bonds can help offset losses, smoothing the portfolio performance over the long term and really complementing the growth potential in the equities.
Great. No, I think you've really effectively highlighted the balancing act that fixed income investments play within a diversified portfolio, particularly their role in risk mitigation and income generation. And it's also clear that fixed income can be a stabilizing force during market volatility. So with that stabilizing role in mind, it's crucial to consider the influence of bond ratings on investment decisions. So Wayne, maybe you can talk a bit about the importance of these ratings and how they impact the investment landscape.
Certainly. So bond ratings indeed play a crucial role in fixed income investing by providing investors with an independent assessment of the creditworthiness and the risk associated with a bond issuer or a particular debt security. Bond ratings are assigned by credit rating agencies. And while they're not infallible, they're quite handy to have out there. So these are firms that you've probably heard of: Moody's, Investor Services, Standard & Poor's, Fitch. And based on their evaluation of various factors, including, the issuer's industry sector, its financial health, its repayment capacity, and likelihood of default, they assign a series of ratings for the capital structure or securities within that company's capital structure. So if we think of bonds as a continuum, from gilt-edged government bonds to distressed and everything in between, the rating agencies are helping make sense of where those fall on that continuum. And the first thing they do is, in essence, they divide those between what are deemed to be investment grade and those that are non-investment grade. So investment grade, there's different strategies and different, regulatory compliance of the things that certain pension plans may have requirements of certain quality. This helps sort of lay these relative risks out in a more clear fashion. So anyways, risk assessment, higher rated bonds, those BBB, single A, double A, triple A, those are all investment grade. And presumably higher rated bonds usually come with decidedly lower default risk, a little bit lower return. But as you move down from AAA to BBB, the expected rate of return will rise, not surprisingly. Then at that delineation between investment grade and non-investment grade or high yield bonds, and then you've got BB, single B, triple C, and below all the way down to defaulted securities. It's pretty straightforward. Then different fixed income managers create strategies to exploit or to invest in those various sub areas. So for example, you could have a treasury security portfolio. Great, that's pretty straightforward. It's all, government securities. You could have an investment grade portfolio that would have government and investment grade corporates. You could have a non-investment grade, like a high yield strategy. You could have a convertibles. You could have a litany of other things. So that's the market segmentation and strategy. And here again, as Ron pointed out, the notion of a thoughtful asset allocation plan that has, representation from each of these in varying degrees that makes sense for a given client's situation. So there's the portfolio diversification. I should say something about pricing, bid-ask spreads, and market liquidity. Not surprising. The ones that are the most liquid, the tightest spreads are the highest quality. The most participants, the most players that want to go and buy those, you're going to find the tightest bid-ask spread, and they'll be the trading in those will most likely be the most efficient. As you move down to high yield, distressed, emerging market, those spreads are going to get a little wider. Trading in them will be a little bit thinner. The liquidity will be a little bit less. And that's, what you'd expect to see. I think so. That's a pretty good complete synopsis of the rating thing.
Yeah, no, I think that's really helpful in understanding how you think about different types of risks in fixed income investing. So given the importance of managing that risk, Ron, maybe you could talk about some strategies on how investors can build or adjust their fixed income portfolios to better manage these risks.
Sure. Dovetail into what Wayne was just saying, that just as with diversification across asset classes in a balanced portfolio, diversifying across various types of fixed income securities can help spread risk and enhance the resilience of a portfolio. Investors can allocate their fixed income holdings across different credit sectors, government bonds, corporate bonds, municipal bonds, inflation protected TIPS, securities, et cetera. Additionally, diversification can occur within each asset class based upon factors like issuer, industry, maturity, credit quality that can further mitigate risk. We've touched on the risk return trade-off, and quality selection is a big consideration. Conservative investors may consider prioritizing high quality bonds with strong credit ratings, which can reduce the risk of default and provide a more stable income stream. U.S. Treasury securities and investment grade corporates can offer relatively low credit risk compared to lower rated or high yield bonds, but they may be expected to result in somewhat lower yield. Managing duration exposure is crucial to controlling interest rate risk in a fixed income portfolio. Investors can adjust the average duration of their bond holdings based on their outlook for interest rates or overall portfolio objectives. As we've said, shorter duration bonds are less sensitive to interest rate fluctuations, while longer duration bonds may provide higher yields and potential for capital appreciation as rates might fall, but they're going to be more vulnerable if rates rise. Further, I would just say regularly monitoring the performance and composition of a fixed income portfolio is essential. Periodic rebalancing can help investors stay disciplined and align with their investment objectives over time. This should be an ongoing dynamic process.
Yeah, absolutely. I think you really offered some practical steps for investors looking to refine their fixed income approach, especially talking about diversification and duration management. And so we do have a question from the audience that I think makes sense to put in here. So someone wants to know if you can talk a little bit about how current interest rate environment is affecting fixed income securities. And then, on top of that, I'd love to talk a little bit more about some fixed income investment strategies that can be used in today's economic climate.
Okay. Well, it'd probably be helpful to start with a brief economic overview so that we're all starting from the same point. we at Gabelli believe that the current market economic environment appears to be healthy with a resilient labor market and good corporate earnings. And although inflation isn't fully under control, higher rates have helped stem the tide. Yet it doesn't appear that interest rates will be heading lower soon, and that the trend is likely towards lower rates, albeit at a slower pace and at a delayed starting point. We recognize that corporate credit spreads are tight and that equities are in their top decile evaluation, but happily, absolute bond yields are still attractive. So if we use a couple generalities here just for discussion, if we assume that the treasury curve is a quarter of a point or so, or maybe 3/8 of a point up or down around 5%, the short end being 530 something, and we're probably at long end approaching 5, but we dip down to about 470 or something for the 10-year right now. I'm guessing, I'm not sure what's happening.
467, 468.
Today. With that being said, the average spread for an investment grade corporate, as an example, is about 100 basis points over the prevailing treasury. Gross terms. The average yield, incremental yield for a high yield is 300 basis points or more above the prevailing treasury base rate. Now, obviously, those things can change, as Ron pointed, the yield curve can change at different points in time based on the treasury yields. And then spreads are dynamic. They can narrow and widen. The end of last year, they narrowed quite a bit. Back in September, October of last year, they had widened. And so those are a dynamic feature. But having said that all, the absolute bond yields right now are still relatively attractive. And so, as we've been saying before, within a thoughtful asset allocation plan, diversification remains a fundamental principle of an investment strategy, especially during uncertain times. So here again, including governments, corporates, municipals, asset-backed, and additionally, allocating a portion of the portfolio to other asset classes such as convertibles or REITs or alternative investments may also enhance diversification and risk-adjusted income. So here again, focus on quality. We've talked about that a bit, but if we talk about interest rate management, as Ron alluded to briefly before, duration management is really important. The idea of shortening duration of a portfolio or investing in floating rate securities can provide potential, protection from rising rates. Alternatively, lengthening the duration in advance of a declining interest rate period might serve one well. So if we look at where we are right now and we anticipate that we might be looking at declining rates going forward, time period undefined, but sooner rather than later, adding a little bit of duration to one's portfolio might serve one well. And whether one does that in treasuries, high grade corporates, high yield, or some other thing, I would suggest that might be attractive. Asset backs, there's certain mortgage securities right now that are very attractive and that people might want to consider as well. And then it's also the question between active and sort of passive. Do you just go buy, an ETF or an index, or are you going to go and find a manager that you feel comfortable working with, who you either like their strategic outlook and their process and strategy, terrific, or are you going to go and play, a tactical set allocation where you find a market movement one way or the other and tactically step in and try and do that yourself with an ETF or purchasing a mutual fund or something like that? Or are you going to leave that to a professional and find that there's a reason to go and have active management, and you may find yourself in a very happy place having done that. And so that's, I think, without specifically giving you a name of a fund or something. It all depends on one's risk profile and tolerance. So I don't want to say, oh, here, go invest, in this high yield fund, or only go buy this treasury fund.
Yeah, no, it's clear that, the nuances involved. It's really up to each investor's decision, how they think about various strategies. So thank you for elaborating on those, and also, commenting on the current economic landscape. Hopefully, Trent, that answers your question. But if there are any other questions, we'd be happy to answer them. So continuing to touch on interest rate risks, that's obviously a significant concern for many investors. So Ron, could you expand on how investors should think about these risks when planning their fixed income investments?
Sure. Again, interest rate risk refers to the potential impact of changes in interest rates on the value of your bond holdings. Understanding and managing interest rate risk is crucial to preserving capital, optimizing returns, and achieving long-term investment objectives. Wayne really got into it. We've mentioned duration a number of times. Duration is a big consideration. So again, a measure of the bond sensitivity to changes in interest rates. Bonds with longer durations are more sensitive to rate fluctuations, while those with shorter durations are less affected. So investors can use duration as a guide to assess the interest rate risk of their overall bond portfolio, and you can adjust duration over time based on your risk tolerance, economic outlook, or market outlook. The shape and pitch of the yield curve at any given time represents the relationship between yields and maturities. The shape can provide insights into interest rate expectations and potential risks. It's a snapshot at a given point in time of what the market collectively projects out into the future. A steep yield curve can indicate expectations of inflation and or rising interest rates going forward, may pose a greater interest rate risk for longer duration bonds. Conversely, a flat or an inverted curve might suggest expectations of an economic slowdown, potential recession, and declining interest rates moving forward. Then there's reinvestment risk. Interest rate risk really encompasses reinvestment risk. Reinvestment risk is when cash flows from maturing bonds or coupon payments are reinvested at lower interest rates. So maintaining a desired level of income can be challenging if rates decline, potentially resulting in lower future returns. Callable bonds are particularly susceptible to reinvestment risk, since lower prevailing market yields are going to increase the likelihood that an issuer might call a particular issue. With the issues have higher coupons might get called. So to mitigate reinvestment risk, investors can consider non-callable bonds, zero coupon bonds, laddering the overall bond portfolio, from a few examples.
Great. Yeah, I'm sure our audience appreciates you elaborating on some of those defensive strategies to mitigate the various types of interest rate risk. So finally, Wayne, to wrap up our discussion before we move into our audience Q&A, can you highlight how you mentioned active versus passive management strategies? Can you touch a little bit generally on how someone might think about customizing a fixed income strategy based on their needs, and then specifically how here at Gabelli you do that for your clients?
So in addition to some of our more defined products, such as mutual funds and things like that, we offer a number of customized fixed income strategies here, as do many other money managers. And customized, fixed income strategies can be tailored to meet a given investor's investment goals, their unique needs, preferences, and objectives. And so we first start off with what's the client's risk tolerance. As Ron's mentioned, I've mentioned a couple times, conservative clients may prioritize safety, stability, and opt for higher quality bonds and shorter durations to minimize volatility and credit risk. More conversely, more aggressive clients may be willing to accept higher credit risk and explore alternative fixed income investments to pursue higher returns. Then there's the question of liquidity and time horizon, or dare I say liquidity needs and time horizon, where if a client needs the money in short term, they may have an entirely different view than someone who's investing for the long term. They may also have income requirements. So if a client is a retiree, as an example, and needs the regular cash flow, they may benefit from a customized fixed income strategy designed to generate steady income. And these strategies may focus on selecting bonds with attractive yields, staggered maturities to match income needs, and diversification across sectors and credit qualities to manage the risk. Then there's tax considerations that people have, and that a customized solution can often help with that. Clients in higher tax brackets may benefit from customized fixed income strategies that optimize after-tax returns or minimize tax liabilities. Strategies include investing in tax-exempt municipal bonds, utilizing tax-advantaged accounts such as IRAs or 401ks, and employing tax-efficient portfolio rebalancing techniques to manage gains and losses. There's also ESG preferences. That's something that, depending upon the political winds of the day, clients with ESG preferences may seek customized fixed income strategies to incorporate environmental, social, and governance considerations into their investment process. These strategies may involve bonds issued by companies or entities with strong ESG practices. It may include the screening out of investments that do not meet specific ESG criteria, or utilizing thematic ESG bond funds to align investments with client values. And then there's other investment constraints and preferences. Clients may have a specific constraint or preference to require the custom strategy, restrictions on industries or sectors, preferences for socially responsible investing, or impact investing for that matter, and considerations related to currencies, inflation protection, geopolitical risk, and a litany of other things. So I think that's, while not totally complete, it's pretty complete.
Yeah, no, absolutely. Really, really interesting to talk more about the different options in the fixed income investing space. So that kind of wraps up some of the key topics that I wanted to discuss. Now we'll open it up to additional questions from the audience. Please feel free to pop any questions that you might have for Ron and Wayne into the chat. We do have one already. Can you discuss your perspective on why fixed income has been so volatile in the last several years?
Well, primarily the volatility of the last several years, going back to the COVID pandemic. Obviously, the changes in interest rates that occurred with the Fed easing dramatically at that time, taking rates yet again another time down to zero. I mean, if the Fed funds target rate was 0 to 25 basis points. Drastic need for liquidity pumped into the market. Rates went to historic lows, and subsequent to that, as we came out of the pandemic, the liquidity that had been injected into the economy and injected into the markets and into the system got inflation really heated up. We got to the point where the rates needed to rise quickly. Inflation went to 9%, I think, a little over 9%. So the Fed was forced to then increase interest rates dramatically, 525 basis points of rate increases over the last couple of years. Now we seem to have inflation under control. Things have stabilized. That remains to be seen how much under control we have it. Obviously, I've said for a while that bringing inflation from 9% down to 3.5% or 4% was the easy part. going from 3.5% or 4% to their 2% target is proving to be much more difficult. So we still think we're going to be into an easing cycle coming up. As Wayne mentioned, we think it's probably starting a little later than most, maybe not as dramatic as most. Back in the fall, the market was forecasting something like 6 or 7 rate decreases this year. Fed eases this year.
And we're down to what, 2 now?
Yeah, 2, give or take, and maybe starting in July, but that's not even a sure bet now. So we'll have to see the way it plays out. But a lot of the recent volatility, to answer the question, had to do with the pandemic, the reaction to the pandemic, and after the pandemic, the injection of liquidity and how that filtered through the economy and the markets.
And predating that, we had the financial crisis, the 08-09
Mhm.
period that saw rates also drop dramatically. And I think that, unfortunately, I think that we kept rates artificially low for a little too long. Or dare I say, rates were kept artificially low for a little too long. We didn't keep them, but we, the general in the United States. So I think that's probably what's being referred to here. But I mean, if you really look back, I mean, 06, we basically had a flat yield curve right around 5%, plus or minus a quarter of a point. And we're really back to where we were. I mean, when Ron and I grew up in, a couple decades ago, there was such thing as passbook saving accounts. Most passbook savings accounts carried a 5% coupon or a 5% interest rate. I'm not sure that that I'm going to go out of my way and say these are like really crazy, high rates, because growing up, I remember the late Carter administration where the treasury rates touched on what, 20%.
Short rates, yeah.
Yeah. So it's context.
Yeah, no, interesting. And thank you for answering that question. We have another question that's related. Do either of you have a point of view as to why the market has been wrong in predicting federal interest rates?
I want to say there's exuberance and there's a herd, and what I'm not sure that I have the crystal ball to answer that question, but hope does spring eternal. I mean, just like now, everyone's, oh, wait till we get back to lower interest rates and we can buy houses again. We may not see those 2% and 3% mortgages again. That may not be the norm any longer. That may simply have just been an aberration that if someone was lucky enough or fortunate enough to have refinanced and availed themselves of that. So I'm not sure you want to add to.
No, I would just say that, go back to a few years ago when the Fed was slow to react and raising interest rates. The market rightly was convinced that the Fed was maybe making a mistake calling inflation transitory at the time, and that rates were going to have to come up a little bit more dramatic. Now, fast forward to last fall, back in October, as Wayne pointed out, the Treasury, the 10-year was touching 5%, the 2-year was 5.25%, something like that. By the end, so the market at that time was anticipating that the Fed was going to have to maybe not even pause, but continue
Raise
tightening
rates, yeah.
and raise rates at the time. By the end of the year, just a couple months later, the 10-year Treasury had dropped from 5% down to a 3 handle, had less than a 4% yield. So the market then, in a 2 months' time, went from being convinced that the Fed was going to have to more work to do on inflation to saying they went too far, and now they've got to turn around and start easing rates again. Now, there's an old saying in the market: "Don't fight the Fed." The Fed has been saying for some time that they can pause for a while, not have to start easing rates until later this year. The market's starting to come back in line with those expectations right now. As a matter of fact, what we've seen in recent days, the market is probably pricing. The Fed is projecting 3 in the last dot plot. The Fed is projecting 3 rate cuts this year. We'll see what that projection comes out in June, but the market's saying 3 is probably too many even at this point.
What's interesting too, that employment has been reasonably strong. Stronger than people would have expected. Forget today's headlines that, Tesla's going to lay off a good chunk of folks and the like, but there are as many stories on the other side that, certain industries not being able to find employees to go and meet their needs. So, and I don't think that, as you said, I wasn't convinced that certainly based on the products that we've been buying, that inflation is totally under control yet.
Yeah, fascinating. I think that adds a layer as to why it, is so hard to, predict the moves from the Fed, almost as hard as picking a winning March Madness bracket. Another one from the audience: how do you navigate the trade-off between liquidity and yield when selecting fixed income securities for your portfolio?
It's a good one for the corporate market.
Yeah. So in terms of liquidity and yield, we generally do not play in the distressed neighborhood. So the extent of our incremental yield is sort of bounded by what we're going to go and get in the upper tier of the high yield category. So I would say that we've never had a liquidity problem. Now, and I'll say this, there's something that there are bonds that I may not like the price that I'm being offered on a given day, given certain market conditions. But rare is it that with the kinds of securities that we're buying on behalf of our clients, that we would not at least have a bid for every security in our portfolio. There are certain securities where there may not be a bid. And so there's a difference between liking the bid and having a tight bid-ask spread versus not having one at all. So in fairness to it's a very good question. I just happen to say that based on the way we approach these markets, we've never had a problem having liquidity, but it is certainly something you'd think about. Now, for example, there are other factors that will influence that. What industry are you? Is this a company that has just one bond outstanding? Or is this a company that has a whole complex of bonds outstanding? Is it, and so it's dependent upon a lot of different factors, but those are things that we do consider when choosing to include a given security in the portfolio or not. However, we don't depend on ratings. We do our own work. We've got a team of over 30 industry experts here that do terrific work. And that's a competitive advantage that we have in our shop that other shops may not. We have the benefit of industry experts that are all cap focused. And so sometimes the important thing to remember with a bond is only you have to be right, as opposed to an equity where you're depending on, dare I say, over 50% of the market participants to think that that security should be higher. So sometimes we're actually looking for those securities that might have slightly less liquidity, slightly tainted market views. If our internal work is correct and we believe it is, we're willing to go and buy those. And quite often we end up with a very happy outcome. But those are quite often places where we might look for opportunity. But here again, we're not doing distressed. I'll be clear about that.
Okay, that's helpful. Hopefully that answers your question, Charlie. So I think we have time for one more question. So the last one from our audience is, what are your favorite finance books for a casual or early investor?
Hmm.
Obviously, Graham and Hodge is a staple of our shop. I think that just for fun reading, Confessions of a Stock Operator has always been a classic. I think that, Peter Lynch even had a book a number of years ago that was for the basic, non-practitioner. It was probably a really good place to start. Any other thoughts?
No, I mean, Gabelli has published several very interesting books and on various segments of the market, deals and more deals, for example. So to toot our own horn, there's a couple there as well, but I concur with what Wayne has said.
Yeah, Confessions of a Stock Operator, that's on my list. So that's nice to hear that you recommend it. Great. Well, thank you both so much for speaking with me today. I'm sure our audience found that very enlightening. And if anyone has any questions, feel free to follow up with myself, and we'll direct your questions to the appropriate members of our team.
Thank you.
Thanks.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.